Okay, today we're going to talk about the 4 myths or the 4 misconceptions or lies that we're told basically about investing, and in particular how it pertains to your retirement portfolio. There's a lot of noise out there about how your investment philosophy should change or your allocation model should change the older you get and the closer you get to retirement. That may be true, but that's not what we're talking about today. We're talking about no matter where you're at on this retirement or investment timeline, you should avoid these 4 things. And the first one is stock picking or stock selection. And this model basically says that there's a money manager or a manager out there that can outperform the market, can pick stocks and determine which companies or which stocks are priced the best and outperform the market over the long term. And this has been proven that most managers do not outperform the market and that most managers do practice stock picking. And how I determine whether somebody looks at or they're interested in picking stocks or selecting stocks is they'll ask me what company I think they should buy or what stock I think is good right now. So you should avoid this type of investing and this number 1 myth at all costs. This is a no-no. Number 2, track record investing. And this basically is saying that if I look at a manager's past performance and how they did in the past 1, 3, or 5 years, that it's going to determine, give me a good idea of how they're going to do next year, the year after, or over the long term. And it's been proven over time that this hasn't been the case, that a money manager's past performance has 0 correlation or has nothing to do with their future performance. So you should not utilize track record investing when you're looking at the principles of your investment portfolio. Number 3 is market timing. Market timing is saying that somebody has a crystal ball and they know when's the best time to get out of the market or when's the best time to get in or out of a certain sector. We saw a lot of this over the past 2 years. People want to move out of stocks, move to CDs, move to cash, move to bonds, or in the late 90s when they wanted to go into tech stocks. This is not a good practice either. Market timing has proven to be detrimental to portfolios specifically because most people get out at the wrong time. They don't know when to get in and when to get out. So market timing is not the best way to invest, and it's another thing you should avoid at all times. And the last one is the cost of investing. Basically, they say what you can't see can't hurt you. So the cost of investing is very important. You should know exactly how much it costs you, dollar amount, how much it costs you in your portfolio to be invested, because this is money that you pay. You pay to be in this investment, whether it's in your retirement portfolio or whatever. The cost of investing is very important. You need to analyze it and determine what the true cost is. And a lot of these are really hidden costs. But there is a cost to investing, and that needs to be determined over long periods of time. This can be very costly to not only you building wealth, but you maintaining your wealth. So the 4 things that you should avoid at all costs are stock picking, track record investing, market timing, and you should look at the cost of investing to determine how much it is costing you to be in the portfolio that you're in. And that's all for today.